Hello and welcome to this video course on the calculation of your taxable capital gain. So there's lots of principles applicable to calculate your taxable capital gain, but today I only want to discuss the framework for getting to your taxable capital gain with you guys. So the first thing that you need to know is where it slots in the taxable income framework. So you will see after your deduction you need to go and add your taxable capital gains into your taxable income. So your approach when you do a question to calculate the taxable capital gain is as follows. We're going to go and calculate either the capital gain or loss on every asset. We're going to add them together to get to something called the aggregate capital gain. From the aggregate capital gain, we need to go and deduct the annual exclusion for an individual, which is 40,000 Rand. And after that, we're going to go and deduct the capital loss brought forward from the previous year. Then we are left with a net capital gain, or the loss. Now, the loss is never multiplied with a percentage. The loss will be carried forward to the next year of assessment where you are able to deduct it against any future capital gains. So if you have a capital gain, you're going to go and multiply it with 40%, and this taxable capital gain will be added to your gross income or into your taxable income framework. So for every gain or loss, we need to go do a transaction to get to the capital gain or the capital loss. And for that, we take proceeds, and from that, we need to go and deduct the base cost. So that will calculate your capital gain or loss. Now you need to go and study how do we calculate the proceeds and how do you calculate the base cost. Some of the assets that you dispose of might not have a capital gain or loss because it is excluded in terms of the 8th schedule of the Income Tax Act. Let's do an example of the framework. Sunflower disposed of several of her assets during the current year of assessment. She had asset 1, 2, and 3, and on that we already calculated the gain or the loss on. So first asset had a gain of 30,000 Rand, second asset had a loss of 20,000 Rand, and the third asset had a gain of 40,000 Rand. Sunflowers have a capital loss brought forward from the previous year of assessment amounting to 2,000 Rand, and you're required to calculate the taxable capital gain, if any, to be included into her taxable income. The first step is we need to go and add up all of the gains and losses of the assets together. So asset 1 had a gain of 30,000 Rand, asset 2 had a loss of 20,000 Rand, and asset 3 had a gain of 40,000 Rand. Then we get to something called your aggregate capital gain, which is 50,000 Rand. From that, we need to go and deduct her annual exclusion, which is 40,000 Rand, and then you are left of a subtotal of 10,000 Rand. From that, we then need to go and deduct any losses carried forward from the previous years, which is 2,000 Rand, and then you are left with a net capital gain of 8,000 Rand. The next step is to go and multiply it with the inclusion rate. The inclusion rate for an individual is 40%, and then you are left with your taxable capital gain. In a question, you will be faced with many different factors, which includes you need to actually go calculate the gains and losses. The point of this video course is just to explain to you how we get to the end. So you need to go and apply all of these principles, go calculate the capital gain on every asset, add them together, deduct the exclusion, and deduct the losses carried forward from previous years and multiply it with 40%. Then another thing, please remember that a loss is never multiplied with the inclusion rate. A loss is carried forward to the next year of assessment. I hope this podcast helped you with the capital gains tax framework. Bye-bye.